Hi, this is Optimus Futures, and I'd like to welcome you all to the third video in the series where we're introducing the OBIO method. In the previous video, we talked about the scope of the OBIO and how it applies to different market conditions and how it yields its use and its benefit to a technical trader in understanding the markets better. In this video, we take a more hands-on approach and try and understand the different signals that each of these indicators that we apply for the OBIO give out and how they can actually help a trader build a credible and a substantial trading method on top of what he or she may already have, or if they're just brand new and just starting to understand the basics of market action and price action and just looking for a strategy that will work for them in the long run. So without any further delays, let's get straight into it. The first indicator that we'll be looking at here is going to be the momentum shift indicator. Of course, we described this indicator briefly in a previous video where we talked about it as the name suggests, of course, momentum shift. It indicates a shift in momentum, as in where the market is flipping from bullish momentum to bearish or bearish momentum back towards a bullish momentum. As far as the momentum shift indicator in the histogram down here is concerned, we have two very direct implications for this in the OBIO method. The first of which is going to be the flip around the zero line. You will notice that it is a very common occurrence that when the momentum shift histogram actually moves above or below the zero line, that's actually the time that the market itself is also turning around. Let's look at a few examples here that will better clarify this concept. If you look at this situation over here, this is right about the point where the momentum shift moves from printing a lot of maroon and red bearish looking bars in the histogram here to posting light and dark green bullish bars on the histogram. And if you see that this is the point in time where the market is actually turning around as well. We had bearish momentum that is reflected by all of this this movement underneath the zero line of the momentum shift, and then the turnaround itself is actually represented by this sharp turnaround above the zero line for the momentum shift histogram as well. This is yet another example right over here. Once again, if you relate this on the price chart, this is right about the price point where that shift happens, and you can see that soon after that we had quite a decent period of selling activity in the market as well. We can go back a little bit further to look at some other examples as well. Let's look at this example. This is another really good one, where again the histogram, the momentum shift histogram, is posting consecutive red bars underneath the zero line, representing bearish momentum. And then soon after that, as soon as the momentum shift actually flips on the zero line, and you start seeing white and light green and dark green bars above the zero line, that's actually the time when the market is actually building more momentum towards the upside. And soon after that, we see a really strong looking bullish move in the market. Once again, pretty much predicted. Predicted here is a strong word, of course, but definitely indicated by the momentum shift indicator. The other extremely important implication that the momentum shift indicator has for our trading here is going to be the use of divergence. We can use the momentum shift histogram and the highs and lows that we see on this histogram as a means to spot divergence on our charts. Now, a lot of technical traders do employ conventional means for spotting divergence, which includes the use of RSI or the MACD indicator. But once again, we have mentioned this before, that the momentum shift indicator is actually slightly different to these conventional indicators in that the math and the algorithms that go behind this indicator are actually modified and designed in a way to make this indicator more reflective to real-time price action. And so we believe that the momentum shift histogram, when used to spot divergence, can actually be more accurate and more reliable relative to some of the conventional indicators like the MACD. So when talking about divergence, we're essentially looking at two different kinds of divergence that the OBIO method and the momentum shift histogram will present you with. And that's going to be the grind divergence and swing divergence. So swing divergence is simply divergence where the distance between the two swing points that you see on the momentum shift histogram can be quite a bit. Let me actually pull up an example here to give you a better understanding. So right here we have a good example of bearish swing divergence. You'll see that we have a swing high being posted by the momentum shift histogram. Then we have a brief period of trading activity where the histogram actually starts printing bars underneath the zero line, and then we once again have a swing high right here, and which is definitely lower than the previous swing high posted by the momentum shift. But if you look at all of this action over here and compare it to what we see on the price chart, we're actually still seeing consecutive higher highs. So that's a typical case of bearish divergence. This, of course, is implying that the overall momentum towards the upside, or the bullish sentiment in the market, seems to be fading away. In this case, of course, this really just meant that the market was going to consolidate and move sideways a little bit more before eventually continuing with the move up. But once again, this is a good example of how having the OBIO indicators and the momentum shift indicator on your chart can give you a decent idea of what the market is trying to do. This period of consolidation, or the upcoming period of consolidation, may not be as predictable just looking at the candlesticks and the price action over here. So that would be your typical swing divergence. Next, we look at the grind divergence, which is a similar concept, except that we have more consistency and more rhythm in the highs or the lows they're posted on the momentum shift histogram. Let's actually look for a good example of grind divergence as well. So this, for example, is a good example here. So we have let's actually use the crosshair instead. So if you look at this situation right here, we have the market create a small swing low, and we have the histogram create a swing low. And then we have the market create another swing low that's just about lower than the previous swing low. And on the histogram, we see that that's matched with a low that is higher than the previous low. And then again, we have the market create a swing low that is way deeper, way lower than all the previous two swing lows. And then on the histogram, that's matched with another low that is higher than the previous two lows. So here we have a more rhythmic action where consecutive lower lows on the price chart are actually matched with consecutive higher lows on the momentum shift histogram, implying very good and very obvious grind divergence. So that pretty much wraps up our direct implication for the momentum shift histogram. As far as the OBIO method is concerned, you'll see that this is going to be a very useful indicator going forward in your technical analysis. We're going to be talking about the channel violation. So this is going to be the situation where price actually hits one of these outer bands, either the overbought or the oversold bands, and gets rejected fast. You'll notice that this is going to be an extremely repetitive and very common market phenomena where, of course, because price is for the most part trading between these bands and this channel at large, there are going to be several occasions where the market actually tries to test these bands and gets rejected. So this actually, there's obviously no doubt that when combined with other factors, this is going to be a very high probability trade setup. One of those factors could, of course, be the dots here. So we've talked about these dots previously, but they're also an indication of overbought or oversold conditions. The yellow dots, of course, meaning that the market is only slightly overbought or oversold. Orange dot would be a higher degree of overbought or oversold trading conditions, and the red dots, of course, is going to be the most authentic indication within the dots category for a market that is either overbought or oversold. So once again, when you see these channel violations and when you see the market sort of rebounding fast away from either the overbought or the oversold channels, bands, coupled with dots, several yellow dots or a few orange dots or red dots, that is usually a good indication in of itself that the market is but most probably overbought or oversold, and maybe a good opportunity for you to be looking to play out a reversal trade. Let's actually go back and see or find some of the really interesting channel violation setups around. Let's look at this example right here. This is a textbook example of what we're talking about. So what we're seeing here is a slight constriction in the bands right around here. You'll see that the market is sort of entering into a period of consolidation, and you see that it's overall in a downtrend. Of course, it's been consolidating for brief periods in the middle, but for the most part, we're looking at a very dominant and strong looking downtrend. And then what we see here is the market actually drags itself towards these overbought bands and gets rejected fast. That is a very good example of a channel violation, giving you the potential or the possibility to enter into a short trade. Let's look at some other examples. Let's look at a bullish example this time. This may classify as a channel violation as well. The only thing is that we're looking at an overall constriction of the bands, and so was actually going to be more of a breakout sort of a story than a typical channel violation setup. So we'll avoid that. But here's a good example again. Notice how price actually rapidly falls down towards these oversold bands and then gets rejected fast. Of course, this also lines up as a support and resistance level. And this is going to be a whole different video later in the series where we talk about combining different factors and different aspects of technical analysis and price action dynamics with the OBIO dynamics themselves to actually create a high probability trading method and system around the same ideology and concepts. So we'll look into that later, but just looking at this example in of itself, it's a good example of a bullish channel violation trade where the market falls hard into the oversold channel, into the band, the oversold band, and then we get a sharp rejection off of the band. Let's actually see if we also had divergence to support our case. We actually did not have divergence here, so that sort of cancels out. But yeah, this is kind of the stuff that we're looking for here, where we're looking to combine the different signals from the different indicators that we have on the chart. Of course, looking at the higher time frame momentum and the trends would also help. The reason that we're not referencing this trend information box as much when we're talking about all these potential trade signals for the OBIO is because this really just reflects current price action only, and as we scroll left of the chart, it doesn't actually update to reflect the price that we're looking at or the period of trading activity that we're looking at here. It will only reflect the current price action, which is right around here. So that's the only reason we do not reference the trend information box as much, but it is of course completely relevant and very useful to allow yourself to better align your trades and basically make sure that you're not going against, say for example, a higher time frame trend. Okay, so next up we'll be looking at the constriction or the squeeze effect of the overbought and the oversold bands. This is going to be the situation where the market sort of gets tightened up and consolidates within either pattern formation or a couple of trend lines or support and resistance levels. Basically any factor of support and resistance that the market uses to sort of gets confined and trades within that tight zone. That usually is a situation that a lot of technical traders find relevant to be looking for breakout trades in. And so the Overbought IO method actually only solidifies it even more because it will give you visual aids in the form of this channel between the two bands, the overbought and the oversold bands, sort of getting tighter and confined, giving you that visual appeal and letting you know that the market is losing momentum and is gearing towards, or is currently in a consolidation phase, potentially gearing towards a breakout situation. As a sharp contrast, of course, there's going to be situations where the market is moving sharply in one direction. That is going to be the situation where the distance between the band is going to be, of course, a lot bigger, giving you, again, a good visual aid that the market is healthy and is definitely moving in that one direction with good momentum. So you can use all this information to actually find really high probability breakout setups and other situations where the market is breaking out of a phase of consolidation. Okay, so let's actually go a little bit further back and find more examples of the market sort of constricting and congesting within a tight zone created by the overbought and the oversold bands and then eventually breaking free. This is one example. It's not the best example because we're already coming off of a strong uptrend here, and the market sort of consolidated. We had a very obvious constriction of the oversold and the overbought bands here, and price eventually sprang up and created more of an upside volatile move with good momentum towards the upside. But we're actually looking at a more obvious example of the market going sideways first, then eventually breaking into a solid trend. This is going to be another really good situation, actually two. So we had the market actually go in a downtrend here with really good volatility and momentum. You can see once again implied by the big difference between the overbought and the oversold bands here, implying that the market was moving with good momentum. And then eventually we see the market go into a very obvious period of sideways trading, and we see the market sort of getting tighter and tighter within a wedge pattern formation. Of course, this activity sort of brings the bands, the overbought and the oversold bands, closer together, and eventually we have a breakout towards the upside. This breakout really didn't sustain itself for too long, and you can see that right where the market actually rebounded off of the overbought bands, we had a cluster of two orange dots. Let's actually see if we had divergence come in here as well. Not quite. So we didn't really have a lot of divergence here, but we definitely had two orange dots here to suggest the market was kind of slowing up. And of course, we had indications from the very shape and size of the candlesticks themselves as well. Usually when the market is coming off into a true breakout, you will see good sized bullish candlesticks, if the setup is bullish, of course, indicating that the momentum is strong. So for example, this situation where the bands here congested and the market was coming off of a period of consolidation, you can see that when the market broke down, even though we were occasionally seeing these orange dots come in, and we consistently found the market sort of pegged to the oversold bands over here, we're still looking at really good sized candlesticks towards the downside, closing strongly as well, indicating that the market is just healthy and moving at a decent pace. This, on the other hand, is slightly different. You can see how the price action is different. We're seeing smaller candlesticks, and you get that feeling that the market is sort of dragging itself up instead of actually breaking out with momentum. Once again, the two orange dots here coupled with the overbought bands, giving us a good indication that the market was slowing down. Look how much the market slowed down during this period of time before the market went sideways once again. So once again, the OBIO here giving us more visual cues and giving us a better understanding of what the market is trying to do. Let's actually look at one more example before we wrap up this video. Here's a really good example as well. Or maybe not actually. It's not a genuine example of a breakout play, simply because the market's actually already coming off of a uptrend for the most part. But we did have decent consolidation here, which actually allowed the bands to constrict, as you can see. And then there's our major breakout towards the upside, more in line with the more longer term uptrend. And then once again, you'll see that the market was actually just pegged along the overbought channel here. We sort of retraced a bit away from the overbought bands, but then once again, you'll see that we did not have any yellow, orange, or red dots along the way, telling us that the market may not be as overbought. And of course, the market in general was up and away from the middle band, which again is a major indicator. The middle band itself is not a tool that we use in the OBIO method to actually or we don't actually use it as a trigger to our trades, but this is a great trade management tool. And when we talk about the actual trade management aspects, entries and exits with OBIO triggers, we'll be talking about the middle band a whole lot more. But for now, you'll see the merit for the middle band as simply being a source of support and resistance, and allowing us to see the bigger picture and seeing how strong the overall momentum is, especially during the time when the market is breaking out and we see the squeeze of the bands here, the overbought and the oversold, eventually releasing price into a strong move either to the upside or the downside. So that pretty much wraps up this section of the series of videos. In the next video, we will be talking about the pitfalls that a trader needs to avoid when looking for OBIO signals. We're going to be breaking down each and every signal that we talked about in this video, and we'll see the pitfalls that need to be avoided and the tricky situations that if you know how to spot them, you'll actually be able to avoid a lot of trickier or less probable trade setups.